Welcome into Compounding Capital, your go-to for value investing. If you love great companies that go on sale, then this might be the channel for you. So be sure to like and subscribe, because in today's video, we're going to hold ourselves accountable. We're going to talk about some of the stocks I got wrong, some of the stocks I've gotten right. I think you're going to be pleasantly surprised that I've been extremely accurate on this channel. Now, I'm sure you can go through and find some inaccuracies. I definitely have been wrong, but what I want to start out with is some of the warnings I've given, whether it was Open Door, trading over $15 a share. I warned people about Open Door. They were hemorrhaging money, that they were heading on an unsustainable path. And the stock got as low as $1.60, now trading around $2.25, which means that you've pretty much lost the majority of your investment if you bought it at $14, $15. Next is SoFi. Now, obviously, I like SoFi. I think it's an interesting business at the right price. When we talk about book value, it's a little expensive. And so when people were recommending the stock around $13, $14, to me, it was a $5 to $6 stock. And where is it currently trading? It's currently trading at $7.52, down nearly 30% over the last few years. I definitely think it's sitting to more of an interesting price target at this point in time. I still believe you want to be buying the stock around $5 to $6 a share, but that's just my personal opinion. Then there was NEO. Now this one was trading for over $30 a share, now sitting at $4 a share. These were all videos that I did about warning of valuation on these companies. It was very similar to the dot-com bubble when we were talking about SPACs that are coming to the market with these ridiculous valuations. Now, I don't create these types of videos anymore because of the amount of hate that I've gotten from warning people about the valuations of some of these companies. So I no longer do videos that talk bad about companies or talk about companies being overvalued, because I've gotten some nasty emails, I've gotten some hate comments, and that's not what I'm trying to do on this channel. I'm just trying to show a process of value investing and the specific route that I take when I value a stock. Now, there's definitely been some companies I've been wrong on. So far, I've been really wrong on Realty Income. When we dived into Realty Income, I had some concerns about the refinancing cycle coming over the next 2 to 3 years. Now, I don't believe I'm wrong right now. I think once we get through the next 2 to 3 years, we're going to see that earnings per share is going to be very, very hard for Realty Income to keep up with a growth rate because of what's taking place in commercial real estate and what's taking place when we talk about interest rates being higher. Now, granted, interest rates have come down, but they're still 2 to 3 times more expensive than they were when Realty Income was in growth phase. And I do think that will impact bottom lines, but maybe I'm still wrong on this one. Another one I got pretty wrong here was Bumble. This was a stock that I thought was pretty interesting, and it absolutely tanked, but I still think it's an interesting stock at these levels. But recently, I've been on an absolute tear when it comes down to stock picking. Sprouts Farmer Market was one of the first videos that I dove into. It was trading for right around $18 a share, is now trading nearly $100 a share, and it's up over 400%. PayPal was another one that I was absolutely pounding the table on recently, especially when it got into the $50 range. We've done multiple analysis on PayPal, and that's where I thought it made a lot of sense to be looking at this company. And now PayPal has absolutely exploded. Going from right around $50 a share where we recommended it, came out anything below $55 a share on PayPal made a lot of sense. Now trading at over $71 a share, which is a 42.2% rate of return. Anybody that caught my Zoom video recently has cashed in on this one, as Zoom was trading for $55 and $56 a share, right in the wheelhouse where we recommended it. They came out with earnings, and earnings absolutely caught everybody off guard. Well, unless if you were subscribed to the channel, and the stock is now up 27% from those levels. And that was in the matter of just a few days. So with markets hitting newer highs, it's definitely getting harder and harder to figure out what is on sale and what is a good deal, because valuations are definitely getting a little bit crazy here. And this is actually where I think it makes sense to be an individual stock picker. When valuations are getting crazy, you kind of want to look underneath and see where deep value might be lying on companies that haven't really participated or might be getting overlooked by the market. So now I want to talk about a few names that I still think have some upside here, even though the market overall is getting pretty crazy, pretty expensive, hard to find deals at this point in time if you're a value investor. But there's been a few names that have come to mind, and one we're going to break down together. Now, as most of you know, I'm still pretty bullish on Pfizer here. I have an ideal price target under $28 a share, basically looking between $25 to $27 to ideally buy a company like Pfizer. I've done multiple analysis on this company and been updating it and keeping you guys up to date on where I think the valuation lies. Now, another stock that I've kind of been wrong on, or it really hasn't done what I expected it to do, and not trying to put the blame anywhere, but sometimes management just doesn't execute to what you think they should be executing to, and I think CVS really stands out as that. This is a company where I still think you have to be looking at it underneath $55 a share. Ideally, the high 40s, low 50s is where you want to be looking at CVS. I think you can get an outsized rate of return if you're able to accumulate shares at these levels. They're still dealing with some problems here, but I do think they have a large enough moat and they're well diversified to the consumer on the healthcare side that I think long-term this would be a good investment. But once again, management has not been executing. But the stock I actually think that's getting pretty interesting here is going to be Kroger, ticker symbol KR. Now, when we've seen Walmart exploding, we've seen Sprouts Farmer Market absolutely explode as well over the last few years. The grocery chains overall have been showing tremendous strength, but Kroger hasn't really participated in this rally. It's only up 11.5% on the year. Over the last 5 years, it's up 123%. Now, before we break down this stock, there are some things I want to point out here. It's trading at 11 times forward earnings, pays a 2.4% dividend. It seems that dividend is pretty safe as of right now. And when we look at the history of that dividend, they've been paying a dividend for 16 years and growing the dividend for 16 years. So anybody looking for a dividend compounder might want to be looking at a company like Kroger. Now, for me personally, I'm all about total return. So I have to buy a stock at a really good price to get an outsized rate of return. And yes, that dividend growth is definitely a bonus as long as earnings can keep growing as well. Now, Kroger's trying to complete this Albertsons merger here, and I think it could get blocked, but I also think there's a chance for it to go through. This is a company that's had pretty steady top-line revenue growth, and we're seeing it slow down recently here. Closing the deal with Albertsons should actually do a few different things here. It's obviously going to give them a larger footprint, so more locations, but there's supposedly synergetic cost savings that's going to take place with the Albertsons mergers that could actually grow Kroger's margins as well. When we look at Kroger's valuation to its peers, definitely trading for a substantial discount. And a big part of that to me is going to be the fact that the operating margins are not as strong as something like a Walmart. I want to reiterate, the reason why CVS has been an underperformer is because of margin problems. And so Kroger could be somewhat of a value trap here. So we want to build enough safety, but also I think there's a huge opportunity if they close the deal with Albertsons. I think the knee-jerk reaction closing the deal with Albertsons is going to be a possible downsized move for Kroger, but I think long-term, they're going to be set up pretty nicely here if those cost synergies are real. Now, a couple reasons why I like companies like Kroger and Pfizer right now in the economic cycle is that if we look at what outperforms in an economic cycle, it's going to be more of those defensive names. We're already starting to see utilities really outperform. Utilities are the sector that's actually leading over the last few months, up 21%, quietly being a monster for this market. But I look at healthcare still being undervalued, and I look at companies like Kroger as a pretty interesting play because if we do go into a recession, these are companies that should still do fairly well. Now, this deal with Albertsons would be the largest proposed grocery merger we've ever seen. Kroger currently has just over $3 billion in cash and cash equivalents. Total debt is sitting at $19 billion, but we can see here that it has come down from $20.4 billion. And they're not issuing any shares. So that's good to see. We would actually like to see some buybacks. And when we look at free cash flow doing anywhere between $2 to roughly $3 billion of free cash flow, we can obviously see this is a very, very low margin business. This is a company doing over $150 billion of revenue and only free cash flowing $2 to $3 billion. When we look at sentiment around the stock, we have a low of 48, a high of 72. Currently, the stock's sitting right around $52 a share. And now the tough part's going to be figuring out a type of growth rate we can put on the stock. Now, they're projecting EPS growth to be pretty strong as well. They're projecting to do a little over $4.65 next year. So let's err on some caution and use $4.60 as a jumping off point. So on a GAAP basis, they're trading around 13, 14 times forward earnings, while industry standards nearly 20 times. So we can see that discount here. But once again, let's just err on caution and call it 12.5 times earnings. We get a $57 stock price for next year, which means that there's really only about 10% upside, which is showing us that if this is correct with earnings, then there's probably only a little bit of upside here, maybe 10 to 12%. We factor in that dividend of nearly 3%. Maybe we're looking close to 15% annualized rate of returns, which is actually really, really nice. But we're not building any safety in that as well. There could be some downside risk on earnings. They could actually lower margins. Inflation could still be a problem for the grocery chains. So we always want to build safety in our analysis when we're running these reports. So after running my analysis, I get basically two price targets. I get a $40 price target from a multiple to EBITDA, and I get a $47.60 price target when it comes down to the DCF model. We get an ideal price target at $44 a share. Anything under $44 a share, I definitely think is interesting for Kroger. And I also believe that if it broke below $39 a share, you really have a really nice opportunity here for a company. Now, we already talked about some of the downside risk here. A lot of debt on the balance sheet, low margin business, but they are one of the largest grocery chains out there. And when they complete this, and if they complete this acquisition on Albertsons, they might have some more levers to pull when it comes to margin growth and growth for the actual company with top line growth. So if that merger does go through and the stock does sell off to my ideal price target, I think the risk versus reward on this company is very, very interesting. Well, hopefully you guys enjoyed my dive into Kroger. That's kind of just me scratching the surface on a company that I'm going to put on a watch list for under $44 a share. We basically only need about a 12-13% decline in the stock for it to start hitting our ideal price target. The other thing is we'd be looking at closer to a 3% dividend yield that's actually been growing over the last 16 years, which is now pretty competitive to the yields out on the open market when we look at treasuries. With the Feds now cutting rates, this is an interesting stock that could have very strong dividend growth and actually top line revenue growth if the synergies go well with the Albertsons deal. As always, guys, appreciate your time. We will see you in the next one.